Hi guys, welcome to my channel. My name is Danae Wolf. I have never done YouTube before, so this is going to be all brand new and I'm going to be figuring it out as I go. But again, my name is Danae Wolf. I am a virtual CFO. So what exactly does that mean? It means that I help business owners understand their financials. My goal is really to make sure that you can utilize your financial data to make operational decisions and improvements in your business. I really feel strongly that if you don't understand what's going on in your bank account, you don't understand what's going on in your business. So I am really here to help educate entrepreneurs and empower you to take control over your finances and make sure that you know exactly what's going on in your bank account. Now, recently, I've had to pivot because everything that has gone on with COVID-19 has presented, a special set of circumstances for business owners. These are interesting times to try to navigate. And what we've found is that the government has given us different stimulus options. So I have really spent the last couple of months educating myself on the Paycheck Protection Program, the EIDL programs, the unemployment for business owners, and really just working on putting it all together in really easy to understand terms and then presenting it with all of you. So today I want to focus on the economic injury disaster loan. Now, there are two components to this. There is a grant, which initially was supposed to be $10,000 and has since changed to be $1,000 per every employee you have with a max of $10,000. So initially we thought everybody was going to get 10 grand, and now it seems to be based on head count. But that is a totally different piece of this. So today what we're focusing on is the economic injury disaster loan. So this program has been around for many years. And what it is in the past is something for a business who was in a zone that was declared a disaster zone. So think tornado, think flood, hurricane, something like that. If your area was deemed a disaster zone, you were able to apply for this economic injury disaster loan. Well, with the devastation that COVID-19 has caused, the government actually went ahead and declared the entire U.S. a disaster zone, which then opened up these loans for business owners to be able to apply. And they've made some COVID-19 specific tweaks. So a lot of people right now, and let me preface this, it's June 12th, 2020. So a lot of people right now are in the stage where you have either gotten your money already from the loan or you've gotten your offer and you're kind of sitting there saying, should I take it or should I not take it? Because there's a lot of restrictions with the loan. There's a lot of things that you can or can't do and a lot of confusion surrounding it. And I have, entrepreneurs telling me all the time, I took the money, I don't know if I should spend it, or, I have the offer letter, but I'm hesitant to actually sign it. So I wanted to hop on and do this video and just give you guys some information on how exactly this loan works, because I know a lot of times reading the contracts can be a bit overwhelming and a little bit like, whew, that didn't make any sense, went right over your head. So I have here just a blog post that I wrote that I'll use as really more so notes for me to make sure that I don't miss anything that I wanted to give you guys. And this is actually posted in my Facebook group, which I will put a link to at the bottom. But it's called The Profit Factor on Facebook. I'm live in there frequently, and normally we're talking about how to understand your business finances. But again, lately, most recently, everything is about the COVID-19 stimulus. So you can find this blog post there and a ton of other live videos and blog posts on information as well. But with the addition of the YouTube channel, I'm going to be making sure that we are updating in both places. All right, so let's dive into this. So the very first thing to note about this loan is that it is a 30-year term. So what's really great about having a 30-year term is that it's going to make your monthly payments low. So initially that makes a lot of people very excited, right? To have this longer term, which is then going to result in a lower monthly payment. But something I really want you guys to think about is 30 years is a long time. So I want you to kind of say, okay, where do I want to be in 30 years? Not just where do you want to be in your life, but where do you want to be in your entrepreneurial journey? Are you still working? Are you retired? What is kind of the vision of where you see yourself in 30 years? And is paying off this loan a part of it? And I really want that to sink in and for you to think about it, because I am strongly urging everyone to take this loan with the plan of paying it off early. I don't think anybody is going to want to still be making these payments 30 years from now. And you'll find that what they approve you for, let's say you get approved for, $100,000 for the loan. Maybe you don't need $100,000. Don't just take it to take it. I want you to actually think about this. Run your numbers, have your accountant help you, see, what you're kind of estimating you're going to need to get over this COVID hump. We're not sure how long it's going to take for you to get to pre-COVID revenues and pre-COVID levels of profitability. So take what you think you're going to need, but I don't want you to overtake. And I want you to take a look at those monthly payments and say, okay, what can I do to pay extra so that I can pay this off sooner? And I'll include in the comments just a free tool I put together to help you guys see how much you're going to be spending on interest, how long it'll take you to pay off if you make extra payments, just because I want to help you guys be able to come up with a plan to pay this off sooner than 30 years. I feel 30 years is extreme to be in a business loan. I understand the reasoning behind it. They wanted to help with cash flow and make sure that your monthly payments were low. But once we have our cash flow where it needs to be, I would make it a priority to get this paid off. Now, the next interesting thing to note is that the interest rate is 3.75. And if you're a nonprofit, it's 2.75. These are very good rates. And just to give you guys some perspective, when I started my businesses years ago, I had a 5-year term and an 8.5% interest rate. So we're talking about a 30-year term and a 3.75% interest rate. So this is definitely cheap money, so to speak. So if you have to go into debt, this is a viable option. This is a good option for sure. But again, my main hesitation is in that 30-year term. I'd really like to see you guys come up with a plan to get it paid off sooner. Now, the other thing to note is that your first payment isn't going to be due for 12 months. So again, when we're looking at cash flow, that's great. That's great because it's going to give us a year for you guys to really get back up on your feet and start getting your revenues up, your profitability up, and start generating that cash flow you're going to need to make that monthly payment. Now, just because you don't owe a payment for the first year doesn't mean that you're not accruing interest. So you will be accruing interest that whole time. And a lot of people are telling me, well, I don't know if I'm going to need the money or not, right? Because none of us has a crystal ball. We don't know how long it's going to take to kind of bounce back from all of this COVID. But I know that a lot of people's plan is I'm going to take the money and just hold on to it and see if I need it. I just want to point out that in doing that, you are accruing interest. So the free tool that I'm going to link at the bottom in our comments, it'll run you through those scenarios. So you can see, okay, if I take the money and don't spend it and just hold on to it for a year or 2 years, how much is it actually going to cost you to do that? So for those of you who are kind of thinking, I'm going to take this as just kind of a security blanket, it'll be a really good tool for you to kind of run through and see what it's going to cost you to do that. Now, another thing I want to point out is that if you take the loan and it's less than $200,000, you're not going to need to make a personal guarantee. So this is something that I think everybody should always try to avoid, having to avoid personal guarantees. We see it in several places in businesses. A lot of times your landlord for your space will want you to put a personal guarantee on the lease. And then we almost always see it on our liabilities. So our business loans, our line of credit, they want you to personally guarantee it. So just a little quick lesson on that. We have, an LLC or maybe you're an S Corp, some type of business formation. And while there's, tax implications of that, there's also this legal layer of protection. So if you have an LLC, you have an extra level of a layer of protection separating you personally from your business. So let's say if someone were to sue you, they would be suing the LLC, they would not be suing you. So it just provides that extra layer. So what landlords do, or a lender will do, is say, we're not going to make the arrangement for your LLC or your S Corp to guarantee this. We want you, the person, to personally guarantee it, because then they know they can come after you personally for the loan. So that sucks, right? That could be kind of scary if you're in a situation where your business is defaulting on maybe its lease or its loan, whatever's happening, and now they can come after you personally. So whenever we can avoid a personal guarantee, really want to do it. So in this situation, they're saying, hey, if you take a loan under $200,000, there's going to be no personal guarantee. If you take over it, there is going to be a personal guarantee. So if you can manage to stay under that 200, I really want you to do that, because I just don't want to see anyone get themselves in a situation where you're personally vulnerable. Now, the other thing that they did was say, if you are taking a loan that is $25,000 or more, the SBA is going to basically take your assets as collateral, your business assets. So let's say you have machinery, equipment, any type of inventory, anything that, think items that are sitting on your balance sheet right now, right? So any higher ticket items that are assets for your business. Essentially, the SBA is saying, hey, if you default on your loan, we could come confiscate your pickup truck that is owned by your business, and we could sell it to make the money to pay ourselves back, the money that you owe us. Or let's default, and maybe they're going to say, okay, we're going to come in and take this new, maybe you're a printer and you just bought like a $20,000 fancy printer. We're going to confiscate that and we're going to sell it to make money to pay ourselves what you guys owe us. So this is something to really consider, because there is terminology in here saying that you can't get rid of your assets. If you were to maybe want to sell them, you have to get permission from the SBA because they have a stake in it, right? Now, in regards to inventory that you're turning over often, right? Let's say you're a restaurant and maybe you order $20,000 worth of food a week. So every week you have, $20,000 worth of inventory. The SBA has collateral on that. They have a security interest in it, but they're saying you don't have to contact them to sell it, right? Because this is normal inventory. Otherwise, you'd be calling them every day. Like, hey, somebody just bought lunch. I need to sell them. So they don't expect you to do that. But I think machinery or equipment, anything like that, any type of a fixed asset, you would need to get permission from them. So again, this loan has restrictions. Like, I want you guys to think about that. Like, yes, I get 30-year term, sounds great, but like, where are you going to be in 30 years? Maybe you don't have the personal guarantee because you're under 200,000, but they have a stake in your collateral. And now you have to think about, anytime you want to do something with your fixed assets, you have to ask the SBA. So there's going to be a lot of things in here that you'll see they're saying, you have to ask the SBA in writing. So let's scroll down here. Okay. So the next thing to point out is there's no prepayment penalties on this loan. So I know that I was talking to you guys earlier about we do not want to actually keep this loan for 30 years. That would be crazy, in my opinion. So I'm urging everyone to come up with a plan to pay it off early. And I'm going to have in the comments below, I'll have some resources for you guys, but one of them is going to be a free tool that'll calculate this for you. So how much are you spending on interest? And then if you want to pay it off early, how much do you have to spend every month? If maybe you say you want to pay it off in 5 years or 10 years. So we'll link that resource below. But basically the SBA is saying, hey, if you pay it off early, there's no prepayment penalties. This is good because a lot of times, lenders are making money off the loan based on, the interest and fees that you're paying every month. So if you pay it off early, they would lose out on the interest and fees, right? So a lot of them will have prepayment penalties that you have to pay in order to make sure that they're still getting some type of compensation. So the SBA is saying, hey, if you pay it off early, fine by us, we're not going to charge you. So this is a really good point about this rule and enforces even more that I really want you guys to come up with a way to pay this off early. And here's this point. So I get a lot of questions about, how do I actually get approved? What is the SBA looking at to determine? So according to the contract, the primary criteria is that they're looking at your credit score and your ability to pay the loan back. So if you remember when you initially applied, they asked you for your revenue and your cost of goods sold. So they're really trying to get a feel for your margins. What is your cash flow? Is there going to be money left over to actually pay this loan payment? And then they're going to look at your credit. I think a lot of people have had their credit run by the SBA. Everybody started, we're logging on to Credit Karma or Experian or something, and we're seeing those hits. So they're definitely running credit and looking at that as well. All right, so now let's get into probably what I'm asked the most. I take the money, I understand the term, it's 30 years, it's 3.75 interest, I know that I have collateral on it, or I don't have collateral, or I personal guaranteed, I didn't. You've kind of figured all of that out, but then you're like, okay, now the money's sitting in my bank account. How do I spend it? Like, what am I allowed to actually do with the funds? So here is what we have. And it's not as clear cut as we would like it to be. And I did have to search through a couple of different resources. I had to go to the standard economic injury disaster loan and read their packet on it. Because remember, I said this is, a loan that's been out for a very long time. But here's kind of everything that I've pulled together, saying what we can actually spend this money on. So fixed debts. So think about this as rent, or maybe a car payment or any type of a bill that, you were already making monthly payments on. So this is something that has already been part of your normal operational expenses, right? Like it's already there. You pay your rent every single month. You're making a business car payment every single month. These are normal debts that the business has that they've entered into pre-COVID that we're making our monthly payments on. So that is operational expenses, right? Because at the root of this, the purpose of this loan is for businesses who were impacted because disaster struck their town. Like I said before, it was a tornado, a flood, something like that. Now it's COVID-19. So this disaster has made it difficult for you to generate revenue and especially to generate revenue that were on par where you were before this happened. So this emergency loan is here to fill in the gaps, right? So if you normally had $20,000 in revenue and now you're down to, let's say 10, well, you still owe all of your expenses, right? It's not like your bills have stopped. So they want you to be able to, that difference, that gap, they're saying use this loan for that. So your standard operating expenses that you had pre-COVID, let this fill in the gaps for that. So payroll accounts for that, payroll. So again, if you are the owner and you typically get paid $2,000 a month, and we have a record of this and we can prove that you've always taken a $2,000 paycheck, that's your payroll. That's a typical operational expense that if COVID-19 hadn't happened, you would have been able to cover. So that is approved with this loan. Then they list accounts payable. Accounts payable is just an accounting term for bills, right? So your electric bill, your gas bill, this is accounts payable. Again, we're talking about standard operational expenses that pre-COVID, this is what you used to pay. This is what you used your revenue to pay. And then they say some bills that could have been paid had the disaster not occurred. So that's fun, right? For them to label it some bills. So that's not very specific, right? And it's this type of terminology that has had so many entrepreneurs confused. Who says some bills? It's not specific enough. So what I did was read more and say, okay, well, what can we not use it on? So again, we're looking at it through the lens of, this is an emergency loan to say, hey, you used to make 20K a month in revenue. You're now down to 10,000. What are the bills that you can't afford to pay right now? Your normal standard operating bills. Take this loan and fill in the gaps until you get that revenue back up to 20,000 a month. So what the loan is not, is it's not an opportunity to improve. It's not an opportunity to expand or scale or do anything like that. The loan is not in place to get you better than where you were pre-COVID. The loan is there to maintain status quo. So if you for years have wanted to replace the floors in your lobby, you cannot use this loan to do that. Now, if every single month you pay someone to come in and wax those floors in the lobby, that's a normal operating expense that your business has always had. And now that your revenue has been impacted and lowered by COVID, it's difficult for you to pay it. You can use the EIDL loan to pay for that because that was a standard monthly operating expense that you've always paid. But renovating those floors, that would be an improvement, right? That would be something extra, something that is putting you in a place where you are better off than you were pre-COVID. So I'm getting a lot of questions about, well, can I do this or can I do that? And I feel like everyone's kind of thinking outside the box here, maybe sort of searching for a loophole. How can I pull this off? How can I pull that off? And what I keep telling people is, whatever you're asking me, can I pay off this car? Can I do this? Can I pay that? If doing that puts you in a better situation than you were pre-COVID, the answer is probably no, because that's not the intent of the loan, right? The intent is for our normal operational expenses. So let's get into some of these things that they outline you cannot do with the funds. So dividends and bonuses. So if you are the owner and you're taking a paycheck and this has been your standard pay, and we have like a record of it to know you on average are making 40, 50, 60,000 a year, then that's fine. You're a part of payroll. You can do that. But if it's something where you typically are paying yourself some type of a bonus or a draw out of the profits, this loan does not replace profits, right? This is a liability. It's a loan. This is not an injection of free money into your business. So you cannot bonus yourself or, do anything like that to pay out of profits with this loan, because it's not a profit replacement by any means. So something to really think about. This is not a situation where you can take a $100,000 loan and say, I'm going to give myself a $10,000 bonus at the end of this year. That's not the intention of this loan. Then it says expansion of facilities or acquisition of fixed assets. So again, we cannot do anything to expand our facility. So if you guys wanted to add on an extra room, some square footage, or don't purchase fixed assets. So if you wanted to get a new piece of equipment that you needed, or maybe a car, a business vehicle, you can't do that. So again, they're specifically saying, you're not going to take the money and profit off of it. You're not going to, pay yourself a bonus or anything like that. You're not going to expand your facility or make some type of an improvement to your facility or add onto your fixed assets by buying, a $30,000 piece of equipment that you've been wanting to. And guys, I get it. I know why you're asking why you want to do this. It's a 30-year term at 3.75 interest. I get it. And if you put it on a credit card, it's going to be, 18% interest. Like, I understand why you want to do it. But again, this is not the purpose of this loan. So we are not able to do that. Repair or replacement of physical damages. So again, we cannot renovate these spaces. This is literally a question I get asked daily. Can I replace the floors? Can I paint? Can I this? It flat out says we can't repair or replace any type of physical damages. Here's another popular one. You cannot refinance long-term debt. So we talked before about how business loans and liabilities typically have, much more stringent rules in regards to the term, usually like a 5, 10, maybe 15 is the biggest I've seen, longest I've seen. And then, interest rates, anywhere between 6 to 8.5%. So yeah, if you have a ton of debt, maybe on a credit card for your business at 18%, of course you're going to want to refinance it. You're going to want to pay it off with this loan and then, make the payments to this loan instead. They're saying you can't do that. That kills the accountant in me because I obviously want to see you have a much better interest rate. And I always advise everyone, let's pay off debt by whatever is the highest interest first. But again, it's not the intention of this loan. So it's not going to be approved. It's not something we can do. So we're not going to expand our facility. We're not going to renovate our facility. We're not going to go buy, some type of fancy piece of equipment we've wanted or a new car. And we're not going to renovate anything, and we're not going to pay off any loans. So anything that would be considered, say, an investment in your business, right? If we renovate or repair or purchase a piece of equipment, we're making an investment, right? You're going to profit off of an investment. That's not going to be improved. And then we can't do anything as far as like financing anything, right? So you can't reorganize these debts to get the lower rate under the EIDL. It's just not allowed. And again, I understand why you guys are asking because it would be the smart thing to do from a financial perspective, but it's not allowed. Then it says you cannot pay down or pay off any loans that are coming from another federal agency. So including the SBA. So if you guys have an SBA loan, right? Because some of you might already have an SBA loan. We can't use these funds to pay that off, right? We can't pay off any of our debts, right? They've already said we're not going to refinance long-term debt. We can't pay anything off. Now, if you are making a regular, say, monthly payment on your business vehicle, you normally pay $300 a month. I don't know. I'm just throwing out numbers here. You can keep paying that $300 a month, but if there's $10,000 left on the car, you can't just pay it off with $10,000. Even if the car interest rate might be 8%, 9%, and you'd rather, pay it off and just pay the 3.75 to the EIDL, it's not going to be allowed. They're also saying that you cannot pay any part of a direct federal debt, including, again, the SBA loans, but it says except IRS. So this except IRS obligations, that's exactly what it says, except IRS obligations. So this is going to be open to interpretation. The way I am seeing this is if you have money you owe to the IRS, it's some type of a pass-through tax, you can pay it because it says except IRS obligations. So you cannot pay the SBA or any type of federal agency. So let's say maybe you guys had something going on in your state. And because there's been a lot of independent programs going on in each state, maybe your state offered some type of COVID-19 loan, and maybe you have a little micro loan. Maybe you have like a $10,000, $15,000 loan through your state, your county, whatever the government agent is. So you're not able to use the funds to pay that, but you can use them to pay the IRS. Go figure. So again, I'm getting this with the terminology of except IRS obligations. So it's not going into a lot more detail as to what those IRS obligations are, but in my educated assumption here, an IRS obligation is obviously a tax. That's how I'm interpreting it. But I like to just be able to give you guys exactly what the terminology says in case, I'm not a lawyer. Maybe you are. So maybe you have a better way of interpreting it, but you can do IRS obligations, it says. Okay, another thing to know, relocation. So you cannot move your business. And if you want to, you have to ask the SBA permission. So again, thinking about that 30-year term, maybe you're like, yeah, 30 years from now, I am still going to be an entrepreneur. I am still going to be in this business. And that's my plan. Okay, but is your plan to literally be in the same exact shopping center where you are, or the same exact building where you are? Because the SBA could tell you no. You have to get written approval from them. And you're going to see several things where you have to get written approval from them. And what I'll do in the comments, I'll go ahead and put an email address for the SBA for the purposes of this loan so that you guys can contact them. This way it's always, in writing that you let them know, hey, I want to move, or here, we're going to get into more examples of you have to submit financials. But I'll link that in the bottom so you guys know exactly how to contact them. And I'll put a phone number as well to make it nice and convenient for you. But you would need to let them know in writing if you wanted to move. So again, think about this. There's a lot of things, and I'm not bashing the loan. I think this is going to save a lot of businesses actually, but I just want to make sure that no one is going into this with their eyes closed. I want to make sure you guys know exactly, what it means to accept this money and what's going to be expected of you. Okay, so here is just a little tip. So we talked about a lot of things that, what you can do with the money, what you can't do with the money. So there are some people who just keep saying, yeah, but I really need to replace the floors. I really need to replace the floors. If flooded, this happened, that happened. So if your business is operating, right? If your business is operating and let's say you have, I don't know, $15,000 that came in revenue and you have your expenses and you know that your expenses are qualified to be paid by the EIDL, use the EIDL to cover the expenses. Track it, log it, which we're getting ready to get into because that is a requirement. And then use that revenue to do these other things that are not approved for the EIDL. Remember, you're going to have revenue coming in, plus you have this loan. So use the loan for what is allowed, use it correctly, and then it frees up revenue that you're generating to do these other things that you want to do. So it's not that I'm saying, the whole 30 years that you have this, you can never replace your floors. No, it's not what I'm saying at all. I'm saying you can't use the EIDL funds for it, but you have other sources of funds in your business. You still have your revenue. So just something to keep in mind. Okay, so now here are some important things that I really want to go over, kind of just the day-to-day of what it means to have this loan and what's going to be expected of you. So it does state that the borrower has to obtain itemized receipts for everything. So anything that you purchase or pay for with this EIDL loan, we need documentation. So I strongly urge you guys to get this onto a cloud, get this onto a computer somehow, digital, so that it's not, just like bins of, file folders full of receipts. There's so many different softwares you could use, but obviously don't want to pay for anything. Snap a picture on your phone and save it in Google Drives. Whatever you guys have to do, just make sure that you have a list of every single item you have paid for with your EIDL with the supporting document. So with the copy of the receipt. This is really important. The SBA can request this stuff at any point in time. So it's really important that we have it. The other thing to point out is that it says borrowers will not use directly or indirectly any portion of the proceeds of this loan to relocate. We already know that. But the law prohibits the use of any portion of this proceeds for relocation. So let's say that you actually get approval from the SBA. You contact them, you say, hey, I want to move. And they say, okay, you can. You can't use any of this money to move. So if your whole plan to move was based on the funds from this loan, just realize that even if the SBA does say, hey, you can move, you still can't use the money from this loan to pay for it. So you'd want to make sure that you have other funds somewhere to be able to actually pay for this. All right, so let's see our next step here. All right, so another thing to point out is people are getting these loan offers, right? And they're kind of like, do I sign it? Do I not sign it? Do I want this money? Do I not want this money? Just to let you guys know the timeline, you have 2 months to decide. So when you get that email, it's always going to come in an email telling you, hey, we approved you for $100,000. Do you want to accept? You do have 60 days. So just something to know. So it doesn't have to be something where you feel rushed and pressured into a decision. Do your due diligence, really think this through, read everything you can, learn everything you can, and make an informed decision because you have plenty of time. Okay, so let's see what our next bullet point is. Okay, so hazard insurance. If you are in a loan that has some type of collateral, right? So we talked about how if you took a loan for more than 25,000, the SBA is going to have a security interest in your fixed assets, in your business assets. So they're saying you need hazard insurance on this stuff. So they have a stake in it, so they obviously want to protect it. So that is what you would have to do. You're going to have to contact your insurance broker, whoever you typically use, and let them know, here's the situation. The SBA has security interests. I've collateralized my fixed assets. I need to get hazard insurance on them. Again, think this through, because if we keep this loan for 30 years, we're keeping this insurance policy for 30 years. So eyes wide open, guys. If we're going into this, we have to have our eyes wide open. So just wanted to point that out. Another thing that is worth mentioning, this specifically states that if you take this loan, you have to have your accounting reports in order. Your books have to be in order. So if you have a bookkeeper, great. You are ahead of the game. But if your books are not in order and you do not have any type of an accounting workflow or process in place, that's not going to fly. Having this loan, it does say borrower will maintain current and proper books of accounts in a manner satisfactory to the SBA. So you have to have a financial process in place. So I know a lot of people just are kind of winging it, and they don't have a profit and loss statement, and they don't have a balance sheet, and it's not an option. It's not an option. So I think it's good, because I believe all businesses should be operating like this. But I know from experience that many of you are not. So it's something that I definitely wanted to point out, because the next bullet point actually says borrower will furnish to SBA not later than 3 months following the expiration of borrower's fiscal year. Okay, the financial statements. So most of us, our financial year is going to end in December, which means that by March, we need to hand in our books. We need to hand in our financial reports. So if you don't have books, this is going to cause a problem for you. So not only are they saying, hey, you have to maintain them, they're now also saying, hey, you have to hand them in March of every year. But then it also says, this bullet point down here, this last bullet point, upon written request, the SBA can require you to pay a third-party professional to review your books. So if the SBA receives reports from you that they can just tell you kind of haphazardly put together, and they don't really look professional, they can require you to hire someone to do it, and you're going to have to pay for it. So again, they're taking these records seriously. So really something to think about. So that concludes all the bullet points I wanted to go over with you guys. I hope that this answered a lot of questions. And just to do a very quick kind of recap, it's a 30-year term. Please don't actually take 30 years to pay it off. Please pay it off sooner. 30 years is a very long time. While you are in it, if you are in the category where you have collateral, you do have to have hazard insurance for that collateral. If you are a for-profit business, it's a 3.75 interest rate. If you are a nonprofit, it is a 2.75 interest rate. You can use these funds to pay for operational expenses that were around pre-COVID. So anything that is of a normal operational expense. So if you need to pay your electric bill, your rent, your payroll, anything like that, those are covered. But you cannot do anything that is going to improve your facility or your business or expand it. So we cannot renovate. We cannot refinance any debt. Nothing where we're investing in the business, and nothing where we're doing anything with financing in the business. Those things are just not going to be approved. We want to keep an itemized list of anything that we spend these loan funds on, and we want to have a receipt for every transaction. And we also want to make sure that we keep our financial records up to date. I really recommend QuickBooks Online, but I also understand that many people can get very flustered when it comes to a software they don't know. So what I'm also going to do in the free resources in the comments, I have a profit and loss template that is very user friendly. It is a Google sheet. I promise you, it is not overwhelming. It comes with a little video tutorial. It is completely free. I will go ahead and post that as well. So I hope you guys got some really great info from this, and please like and subscribe this channel. And then I'd love to see you over on Facebook in my private group, The Profit Factor. Talk soon.